dealing with human beings, and like mental health is a real issue in startups. It's a very lonely place. If you're a CEO or an executive of these companies, it's like lonely is the head that wears the crown.
Welcome to UpTech Report. This is our Founder's Journey series. UpTech Report is sponsored by TerraLeap. Learn how to leverage the power of video at terraleap.io. Today, I'm very excited to be joined by my guest, Kyle York, who's based in Manchester, New Hampshire, CEO of York IE. Welcome, man. Good to have you on.
Great to be here.
Now, your company is not one of actually our typical guests. You're not necessarily a SaaS company. Rather, you're serving SaaS and tech companies. And you're a unique blend of both investment and services company. So, or what you say on your website, a vertically integrated strategic growth investment firm. So basically those out there who are entrepreneurs, operators, and other investors, this may be, you guys are kind of one to look at. Help me understand, on your site, you state, let's reshape how startups are built. Tell me, like, what was the problem when you set out to start York IE? What were you trying to solve?
Yeah, sure. Well, great to have me. I'm excited to be here. Yeah, I mean, I think I have a long track record as an operator, so a sales and marketing oriented background functionally in my career. And so, a lot of tech startups are clearly founded by technical founders and engineers who can build things, right? And I think that they tend to think about sales, marketing, brand building, messaging, positioning, sales scaling, all the things that I know how to do, later into their lifeline. And, I think you marry that with the just ridiculous amount of capital flowing to early stage companies and the size of venture funds and venture rounds. And, this sort of pattern of, having milestones in your pitch deck to the next fundraise, to the next fundraise, to the next fundraise. We just think needs to be rethought and reshaped. So it's really those two things. It's a kind of marketing, kind of go-to-market approach, and then also just kind of recalibration on how to build pragmatic, scalable companies.
Not just about raising enough funds to get to the next raising of funds, but actually getting clients, getting customers, getting revenue in the door, and the services to help you actually scale. Not just, hey, yeah, you should get some customers out there.
Yeah, I mean, a lot of the manifestation of York IE, like I said, came from the operational career. But over the years, I helped build a company called Dyn that was an internet infrastructure company that sold to Oracle in 2016. We got that company to 100 million ARR, sold for a pretty penny to Oracle. I spent 3 years as a general manager inside Oracle. And, the most fun I had, I was doing a lot of moonlighting as an angel investor. I was creating investment vehicles. I was doing advisor gigs, board seats, co-founding startups, just sort of like, work's my hobby, hobby's my work. It's sort of always been how I've rolled. And what I was realizing was I was a really good pair of both operationally in my day jobs, as well as moonlighting as an advisor, board member, investor to, again, technical entrepreneurs or founders or domain experts from other areas, and just know how to build very scalable business models. So that's really what we're doing. And it's trying to kind of manifest that with a team and organization. We are building our own SaaS company inside York IE. We have a underlying SaaS platform called Fuel. That's a marketing competitive intelligence platform that our investments practice and our advisory services practice today lives on top of and leverages. And then over time, we're going to open that up for self-service team enterprise accounts to the market as well. So it is a complete hybrid. It's, it's a little bit venture firm, a little bit consultancy, a little bit SaaS business. And I think we're disrupting 5 or 6 siloed and independent, market spaces and institutions that, frankly, I just don't believe are purpose built for small companies, scrappy startups, high urgency, high velocity, lower budgets, and those types of things.
You're trying to, I think we, in our previous conversation, you were saying throwing sand into the gears of big VC funds out there.
VC funds, analyst firms, management consultancies, large media entities, PR and marketing agencies, if you investment banks, if you look at all these, again, large institutions, multi-billion-dollar industries, they're all actually trying to get the most dollars they can per month out of you or per year out of you right now. or if you're a venture firm, deploy as much capital in you as possible because they want to own more of your company. I think the whole idea here is how do you more practically and pragmatically scale your startup, and you need the resources and the infrastructure around you to do so. And so, there just hasn't been, again, this vertically integrated model that can get some capital, sure, but also comes with a heck of a lot of go-to-market expertise and is pretty laser focused on how to kind of shake it up and do it a little differently.
So shifting to the conversation of a typical SaaS or a tech company that's coming up, what do you see as the common challenges that that they're facing as these CEOs and founders of new companies? What are they facing right now? And if you had to give some advice and tips, what comes to your mind?
Yeah, well, I mean, the public markets, we specialize a lot in enterprise software and internet-enabled startups, and the public market multiples are through the roof on the successful ones. So if you look at the Salesforces, the Splunks, the Workdays, the Fastly's, right? Like these companies' multiples on revenues are disgusting, 20, 30, 40 times, right? So that cascades all the way down to early stage startups. And there's been this sort of illusion or vanity driving behavior culturally that's happened in the startup landscape of chasing the outliers, right? And trying to become the outliers. I want to be the Uber of blah. I want to be the Airbnb of blah, right? And you hear this all the time. And again, that's just, if you think of like pragmatic small business or Main Street business, and just like regular businesses that aren't trying to raise capital or want to bootstrap or want to be profitable, like it's just not the model, right? So we live in this sort of bubble. And so I think this practically like great companies are self-sustaining. Great companies are have staying power, have scalability, and I think capital should be a choice based on accelerating opportunities or driving opportunities. And instead, I think it's become like less of a choice and more of the de facto. And I don't know if that's necessarily great for the world, because eventually stuff will course correct, and there's going to be a lot of casualties out there.
Not everyone can be a unicorn and just saying, I want to scale to the utmost degree. So would you say that's kind of where you guys focus in on, is not to say people just want to become the next unicorn company that takes over everything, but there are plenty of business opportunities that could scale. They're just not going to scale to necessarily tens of billions of dollars.
Yeah, or they could, but like preserve optionality along your pathway. Like don't make it a binary thing, right? Like if you raise $100 million, then you better be worth 500 million to $1 billion, or else you're not making a return on capital to your investors, right? I know a lot of great entrepreneurs who have sold companies for 20 million, 10 million, 8 million, 50 million, and they owned 80, 90, 100% of their companies. Like those guys are multimillionaires, have created generational wealth. They're incredibly successful, but yet you don't read about those stories in Business Insider, Forbes, or TechCrunch, right? And I just think that's unfortunate. So I think our model is, yes, we are definitely hoping to build the most impactful companies in the world. I'm not anti-VC. We co-invest in, we are one. It's just that I think that the financial engineering of companies, or the binary capitalizing of these companies that makes it either a unicorn or a bust, is just incredibly unfortunate. And so if we, from more of an operator lens, having been there, done that, and having now helped portfolio companies be successful, if we can help them just be a little bit more thoughtful and strategic about that path to preserve the optionality, then I think we can heavily differentiate. We will still have IPOs. We will still have billion-dollar exits, but I think, how do we also make sure that the $50 million exit or the $30 million exit is still a big win for everybody involved? I think that's the most critical component.
It almost seems like a mind shift or culture shift to go from only giant $1, $5, $10 billion exits. That's the standard. That is what success looks like. To make the shift now to say, actually, if you make a 50 or 100 million or even less exits, that's a good thing or a growth there.
It's a win in the win column, right? I mean, even if they bunt single into first base, we're dealing with human beings, and mental health is a real issue in startups. It's a very lonely place. If you're a CEO or an executive of these companies, it's like lonely is the head that wears the crown. I mean, it sucks most of the time, right? And I think what people see, all the success and the glamour and the money and the riches and the fancy room I'm sitting in or whatever, right? Like, but at the end of the day, like, I was laying on MRI tables during the rise of Dine, thinking I had brain tumors because I was getting, migraines for the first time in my life, right? Like it's really, really difficult to build a big company. It gets more and more difficult to build a big company if you haven't done it before. It gets more and more difficult if you have VC firms and PE people who have never worked a day in your shoes, nitpicking you and digging into your financials every quarter and providing governance help. So, I think it's just a different psychological shift. To your actual pointed question, we look for companies that are disruptors. They're finding boring spaces or tech laggard industries, and they're saying, hey, there's got to be, or services industries, and saying there's got to be a different way. Even at York IE, I just named a bunch of industries, and I'm building a tech platform with layer on services and layered on investments to disrupt the establishment, right? And that's what we love. One of our most recent deals is a field services software platform for the pest management space, right? Like, what the heck? Another one was a virtual reality platform. We haven't even announced this one yet. Virtual reality platform for safety training in the oil and gas industry. Like, what the hell? But they're looking at these spaces and they're like, how did people solve for field services before? It's like, yellow notepads and, printed paper receipts. And how did they solve for safety training? They brought in people, we rented a space at a hotel and didn't do it virtually, right? So there's different industries that are just stuck in the dark ages, and it's not always rocket science, but it's basically like they can be really disrupted and get pretty big. And I think that's the biggest thing we look for and opportunities we look for.
Let's hear from some of the insights that you've gathered both from your operational experience and managerial and leadership when it comes to some of the core components of running a business. Hiring. Let's start there. Do you have any operational philosophies on good hiring practices? They're building an initial team to grow a startup. What kind of advice do you have?
Yeah, I think, early stage startups, people need to be more generalist than specialist. And I think this is a really tricky dynamic for people. Just because you're a generalist, it doesn't mean that you don't veer towards a functional skill set, right? Like, I've become a pretty good generalist entrepreneur, but I'm really a sales and marketing guy at core, right? And so that's the way I think that is mistaken a lot. A lot of times boards or people or founders get critiqued for not being able to be the best finance person or a great marketer or a good product guy or gal. And at the end of the day, you need to build these teams based on complementary parts, right? So you need to surround a technical founding CEO with a really good business person, a really good salesperson, a really good product person, a really good finance person, right? If it's a CEO from a services background who's building a SaaS business, to make sure you have SaaS technology, a head of platform, a head of sales, a head of customers, like these types of things. And I think a lot of times what ends up happening is people haven't sat in the shoes of building a company. They just get mad that the archetype of the CEO and founder isn't the archetype of a CEO in their world. Like, they're forgetting it's a CEO founder, not a CEO, right? And that's a very different archetype, right? So I always talk about complementary parts. And this goes to obviously the executive and leadership teams, but then, all right, get to the next level, right? I was a sales leader. I was your archetype of an entrepreneurial enterprise sales leader. I needed operational help. I needed sales management help. I needed analytical help, right? So when I hired around me, I didn't hire a bunch of me's. I hired people who are complementary to me in my sales organization. And I think, again, that Strength Finder, I don't know if you've ever seen the book Strength Finder 2.0, like, I couldn't believe more in knowing what you're good at and doubling down on that. You still be generalist, but doesn't mean you need to be a rock star in every category, but make sure you're certainly a rock star in the area of your strength.
I love it. Now, when it comes to probably the biggest area you have advice on, is it funding? What do you see as the biggest mistakes one can make when seeking funding and getting, especially as we've this conversation of don't necessarily just go for a giant VC fund. What are those biggest mistakes that you see people are making?
Well, I think there's become a pretty big gap in the earliest stages, because seed rounds and pre-seed rounds are getting so large and the funds that invest in those companies are so big that it's pulling everything sort of up market. And there's become this gap in the earliest stages between like what used to be like friends and family rounds and then angel rounds and then seed rounds. There's almost like this huge, pit of like, what do I do beyond like the money from my neighbor and my rich dad and my co-founder's friend and whoever, right? So I think this is one of the biggest issues is there ends up being a lot of dumb money put into the earliest stage companies that provide zero value and zero help. And then those people end up being like, what the hell happened to my money? Because it's become so passive, right? So, I mean, this is a big part of the York IE model is go as early as possible, right? Have enough of a cash infusion and then be able to syndicate out to our friends and partners and other funds, but then be really hands-on to make sure we help the companies get to the next milestones of customer revenue, traction, growth, whatever, maybe the next funding, but just do it a little bit sooner. So I think that's a big thing. It's the focus on those key metrics and those key KPIs, focus a little bit more on smart money. Again, it's hard to find smarter money in these earlier stages, and then just pragmatically capitalize yourself over the long term. You see too many of these like $15, $20 million rounds. If you just do back of math on that, if you're doing $500,000 ARR, $1 million ARR, and you get, a $15 million round, it's somewhere in the 30s to 50s pre-money valuation. Like that means your company needs to sell for 150 million to give a return to those VCs. So you just at $1 million ARR said you're going to definitely sell for at least 150 million. Well, that means you need to get the 20, 30, 40 ARR in the next 5 years or they get paid back and the common shareholders make nothing, right? So I think you just have this just because it's frothy doesn't mean you shouldn't be pragmatic and make sure you're doing the math on the exit or the next round that makes sense for you. So I think it's those two things. It's that sort of dumb money married with not like a lack of pragmatism on what it means to get a private market valuation moving forward. A little anecdote I love to tell on that. When we sold Dine, it was a rumored $600 million is the price point. There was a company called Simplivity that was acquired by HPE in like the same 3-month window. And I got a lot, it was a Boston company and we were in New England, we were in Manchester, and I got a lot of inbound saying like, oh, you guys must be pissed. Simplivity sold for $25 million more than you. And it must be annoying that you weren't like the top deal, whatever. And I'm like, are you kidding me? Like Simplivity's last private funding was at 1.2 billion. So they just sold the company for half their last private funding round. Like nobody made money. That is a dumpster fire sale. And again, glad they got a good home, good it landed, but not all exits are created equal. And I think that's the problem when you see the headlines in the funding rounds or the exits. Like even these funding rounds, a lot of times they're recaps or you're buying out early founders or early angels. Like not all the money is always going into the companies. And I just think there's so much nuance to our world, but it's become so headline and vanity that it distracts a lot of people.
Yeah, you miss what actually is happening because it's just a headline and outsider perspective. Now, one of the core focuses that you have, well, and actually your skill set is marketing and sales, right? Actually get a company that makes money, then the valuation can obviously be tied to that. So speaking of marketing, what do you see as some of the common mistakes a lot of early stage founders and startups are making with their marketing efforts and sales efforts?
Well, they don't do it. I mean, it's unbelievable. A lot of tech founders, especially, they know their product so cold and its use cases, and they can do a lot of founder selling to get to those first, million or, ARR or 10, 20, 30, 40 customers. And they forget the model that needs to be created to make that repeatable, to continue to grow the growth rate and continue to invest in it. So they don't do it and they wait too long, honestly. And they have founder syndrome and it's a challenge. So they're also, I think it's really hard about marketing in the early days, especially marketing. Sales is a little bit more coin operated in the early days, but it doesn't have instant gratification all the time, right? So we call it drumbeat marketing. We have an advisory services module, our marketing communication services module, and what we practice is drumbeat marketing. And it's basically the concept of having really strong messaging and a really strong messaging hierarchy from vision to mission to taglines to descriptors to boilerplate, all the way down through the who we are, what we do, how we do it, core industries served, core buyer personas, core use cases, core value props, right? All the way down into the hierarchy, and then come up with your thematic point of views that make you unique and different all the way back into your product, and then tell the world about it every single day, all day, across all mediums, right? And do that all the time, consistently, forever. And again, startups will sit there and say, well, what the heck, I didn't get enough leads and we launched the webinar yesterday, or what the heck, we got that article in BI, I didn't get any deals tomorrow, or and they forget that it's all these ingredients in the storytelling and the creation of that momentum that puff up the peacock feathers and helps drive long tail. That is, especially for SaaS business, recurring revenue SaaS business, is critical, right? So I think it's, if they don't do it, or they delay it, or they do it later, and then it's they also don't do it consistently and look for instant reward that doesn't always come. And that's why, by the way, so many startups go do paid marketing right away. And it's like, you shouldn't do paid marketing ever till you own your own channels and earn earn media before you ever spend $1 on marketing.
All right, you're just like packing in tons of little nuggets here, so I have to like unpack some of this here. First off, so drumbeat marketing. So that's your term, drumbeat marketing, and the idea of having clarity all the way down the funnel, so that even from the outside, that the messaging, the vision, down to like the who you're serving is all clear. And then when you say that drumbeat, that you're being consistent with it, always pushing out, but only on your own channels, your own content. You're not paying for it at the beginning. It's only once you have all that established, then you can push money into paid advertising, etc.
Owned. So that's your blog, your website, your social, the third-party channels, the Crunchbases, the AngelList, the social media. Own your own, what you can control, and push content out through it, right? Could be a Medium post, could be Substack, what have you, right? Then it's earned. Okay, how do I get on podcasts like this one? How do I get speaking gigs? How do we win industry awards? How do we get media coverage? How do we get analysts writing about us? How do we get influencers posting about us? Earn it based on having a really strong owned platform. And then over time, if you want to start paying for events, or paying for affiliate advertising, or paying for digital advertising, or paying for social media advertising, then you should start to do that, but only when you've basically nailed that foundation.
What are some good metrics on how long you spend on just the owned, and then earned, and then paid?
Yeah, I think of it more on the owned side. I look at a lot of web traffic, right? It's like, like when we launched York IE, it's a great example. I mean, we were Alexa 8.5 million website ranked, right? Like, it's like kind of like no one went to it. My mom, maybe one of my brothers, my wife occasionally, whatever, right? We're now Alexa 96,000 as of this morning, right? So we've literally climbed the ranks. We're also the number 28 most trafficked startup blog in the world, according to FeedSpot, right? So we've just kind of like driven this demand, and that demand is leading to more traffic, more unique visits, more engagement, more conversion on all of our channels, right? So through all of our funnels. So that's like the first thing. I actually don't think of that uniquely different though than earned, right? Owned and earned is just like, is it my channel or is it someone else's? But it's the same thematic messaging consistently told through whatever medium is possible. And again, eventually that can go to LinkedIn ads, or that can go to paid advertisements, the sponsor of your podcast, right? Like eventually you can get there, but I just, not until I think you nail and sort of create the moat around your own brand and the storytelling that you're doing.
When it comes to those actual marketing efforts, the tactics that you do, what are you seeing working really well right now in today's where everything's digital? What have you seen as performing the best, and that you're advising your own investment startups to focus on?
Yeah, we are huge believers in content marketing and blogging. I mean, literally, and not blogging just to blog, but blogging about the challenges and the solutions that your customers are looking for. So, content marketing mixed with SEO and really thought leadership based is the stuff that we're seeing, help kind of build categories. You're seeing this whole move to like category creation, and that's all it is, right? It's thought leadership, it's SEO, it's earning search, it's owning search terms, it's literally just beating that drum. So that's the drumbeat marketing stuff is the number one thing that we're pushing on companies is build a brand, tippity top of funnel, as big and loud as you can. You're seeing a lot of trends right now, like the building in public thing is huge. That's really what it is. It's not just talking about your product, your feeds and speeds. It's also talking about your company's evolution. You're building the problems you're solving for customers. We call it the market in approach. It's like most technical startups are product out. I think I can build this. I'm going to go build it. I'm going to launch a lot of features. I'm going to push them out to the market. We look at it more like, who are the players in the market? How are you uniquely differentiated? How can you drive awareness, visibility, go to market in the world, and know your competitor is cold, right? And that's why like Fuel for us, our SaaS platform, it's a market and competitive intelligence platform. It's basically like, if you know yourself and you know your comparators and your competitors in your universe better than anyone else, you'll be able to uniquely differentiate by positioning yourself up against them.
Your particular SaaS element, it's providing insights on what your content should be and what your messaging should be based off of
there's components of that. So basically, think of it like it's a private company database where we're aggregating hundreds of third-party data sources into a complete and connected profile of all private companies. And then that rolls up into market views. And then that rolls up into our research, our news, our content, our perspectives on top of those markets and on top of those companies. So think of it like an operator version of a PitchBook or a Crunchbase or a Traxon. It's targeting more, executive personas, product, corporate development, business development personas about strategic growth. And then we basically built this this concept called Smart Notebooks on top of it, which is in essence a CMS that lives on top of the data sets, so you can do comparative analysis or content aggregation and curation, or reporting for investor comms, or all these different types of tools that are actually bucketed into our service advisory modules. So it's like you can either use the platform self-service, or you can work with us to layer on some white gloved services on top of it. Now, I should be clear. Right now, we're using the SaaS platform to run our investments practice and to run our services practice. And so if you're an investment partner, York, i.e. high net worth individual who invests with us, or if you're a founder that's an advisory client or a portfolio in our portfolio, this is how we're delivering our reports. And we haven't opened it up and publicly launched it. We plan on doing that in May of 2021.
Got it. Okay.
You'll be able to go to the website, put a credit card in, and use the platform.
Yeah, well, that'll be exciting when that launches outward. Then folks can be able to start utilizing it. But you have it for right now that you use it yourself, which should say that there's value because you're using it yourself. I'm going to wrap up with two final questions here. For those leaders out there, any books, audiobooks, podcasts that you're currently listening to or have read in the past and would recommend?
Yeah, that's great. I love the old school Think and Grow Rich by Napoleon Hill. I don't know if you've ever read it, but it's one of the most down to earth, doesn't matter the business, lessons of how to think about, how to build an empire or how to build a great career or how to, take care of your family, whatever your measure of success is. Right. So I love that one. There's also there's a series of books by a guy named Jeffrey Fox. Not a lot of people know about. He's written these things like, one of the books is How to Be a Rainmaker. Another one's Don't Send a Resume, How to Become a CEO. These are quick reads, but they're like this. I have a shelf in the other room of all of them. And they're just like these quick reads that are good, like nuggets of inspiration and perspective on business building. So I've got some of those like different books on the shelf. And then I'm just an avid Twitter user, LinkedIn user. I follow most of my peers and contemporaries and just kind of keep tabs on the market. And I use our Fuel platform to follow all of companies that I like or aspire to be like or track.
Last question for you. What kind of tech innovations do you predict we'll see in the near term, next year or so, and long term, 5-10 years from now?
Yeah, I think I actually was just talking to somebody about this the other day. Like, we hear a lot about AI, but I don't think we necessarily hear a lot about AI like, um, as automation. Like if you think about workflows and you think about like algorithms in software have always been there, right? Now they're called AI and ML and NLP and all these like acronyms and whatever. But I think what you're going to start to see is a lot of more and more manual behavior become not just automated using AI, but also outcome driven using AI. So I think the thing that I've been watching a lot, and we've been seeing again across industry, is the kind of real practical uses of machine learning and the real practical outputs of AI happening in software, where to date it's like everybody would put in their pitch deck and they'd be like, is there anything like actually going on here, or is this just all hard coded capability? And I think you're actually starting to see it manifest into real machine learning, real natural language processing, spitting out amazing artificial intelligence. And I think you're going to see that cross industry.
I love it. I love it. All right. Well, thank you so much, Kyle, for sharing both your insights and what you guys are doing. For those that want to learn more, they can go to york.ie. Is that correct?
What's the web address? York.ie. Yep. That's an Irish top-level domain. I come from a DNS domain name system industry. Then we're at York Growth across all social channels as well.
Got it. Well, thanks again for your time, man. For those who want to check out more, you can also go to uptechreport.com, see the full interview if you're watching this somewhere else. And we'll see you guys next time. Have you seen a company using AI, machine learning, or other technology to transform the way we live, work, and do business? Go to uptechreport.com and let us know.